What's up guys, it's Nathan here. Today we have Jeremy Sheppard with us, who's going to talk about how new properties perform in the long run, whether you should buy regional or in built up areas, and Jeremy talks about his last 30 years of property analytics and how this one pattern still amazes him. Does that mean you shouldn't buy new or even a townhouse for that matter?
Townhouses are an interesting opportunity to get into the market at a cheap angle. If you couldn't afford to buy a house, I wouldn't be concerned that it's a townhouse. There's nothing wrong with that. You generally don't find that you have 200 townhouses pop up in the suburb over the next couple of years, creating oversupply like you can for units. Townhouses aren't an issue, but definitely newer property has been shown to underperform because of the faster rates of depreciation. Most people think of depreciation as being a tax advantage. It does mean you pay less tax, but that's because you are claiming a loss. If you claim $10,000 in depreciation and you're paying tax at a marginal rate, let's say it's 40 cents in the dollar, then you might pay $4,000 less tax. That doesn't mean you're better off by $4,000. It means you're worse off by $6,000. You're not worse off by 10, you're worse off by 6, but you're still worse off. If you buy an established property that's more than 40 years old, then there is no depreciation, effectively no depreciation. You're not worse off at all. And that's probably the reason why historically these new house and land packages have underperformed established areas.
Definitely makes a lot of sense. And that, I guess, does that mean then you should avoid regional areas and look more in built up areas, or is there one area that's better than another area?
Yeah, it's funny that you asked that, because I would have thought that the biggest significant urban areas, the biggest cities like Sydney, Melbourne, Brisbane, Perth, Adelaide, that they would have had better performance over the long term, at least. Looking at historical data, that's not the case. Even relatively small, significant urban areas, cities with a population of just over, say, 10,000, have still had excellent capital growth over the long term, in line with some of the bigger significant urban areas. There's no harm in investing regionally. However, I would caution investors buying in like mining towns, where the population is on a single industry, where you don't have that economic diversity. If that industry suffers, then that town will suffer. You do want some degree of economic diversity, and that usually means buying in an area where there is a population of tens of thousands of people at least.
And you talked about that arbitrage in that prices tend to follow that average over the short term. Should you be thinking more long term or short term, or how long? What should you be thinking as an investor?
Well, it takes a long time to become financially independent as an investor. You do need to have a long-term view, because it doesn't really matter so much where you buy over the long term. If you are going to hold for something like 30 years, picture someone in their late 30s, for example, and the sooner you get into the property market, the better, obviously. But my preference is to enter a market right now that has significant demand relative to supply, so that you've already got some equity there, which acts as a buffer. Should interest rates suddenly take off, for example, you lose your job and you're forced to sell, well, you've already got some equity there. You can pay the lender back, and you might have some profit too. But when you buy into a market, you get that quick capital growth over the next 2-3 years. You can then leverage sooner against that and buy a second investment property and do the same thing. And then after, say, an accumulation period of maybe half a dozen years, you can just sit back and let time do its thing, get on with your life. Or you might be more of an active investor and buy and sell, trade properties. You sell the property at the peak of the market. You need to know what you're doing there. You definitely need to be able to read supply and demand well, but it is certainly possible, even with the high transaction costs of stamp duty, capital gains tax, agents commission, and so on. It is still possible for property investors to do that.
Then how do things even out over time?
Yeah, over time, it really doesn't matter what your holding strategy is, if you are in the game for long enough. So someone investing in their 50s, for example, they might not have as much time on their side. They need to make sure that they get into a market where in the next 5 to 10 years, they're going to see some good growth. But someone who's starting young, time in the market covers over a large number of mistakes. If you have time on your side, you can be confident of jumping in the market almost anywhere.
What happens if you wait long enough?
Well, eventually, let's say you've had some lousy capital growth and you've been dissatisfied with your foray into property investing. After maybe 20 years, you'll be surprised that property market will pull back. It will catch up. Whenever I do an analysis of two particular property markets over a long enough period of time, I'm amazed at the two curves on the chart, how similar every circumstance is. There's always one market that gets away from another, and then the other one, the trailing one, catches up. Sometimes it overtakes. And so you get these pinch points where the two markets come together and then they diverge again, and then they come together and they diverge. You won't have two property markets growing at the same rate over 30 years, but over the long term, that underperforming property market will catch up. And it's one of the metrics that we look at with the demand to supply ratio is we call it market cycle timing, where we look at the historical performance of a property market and see, well, over the last 10 years, has it underperformed? Because if it has, history shows that it is more likely to catch up. If you have a long-term approach and you're dissatisfied with your property, you just hang in there, everything will come good in the end.
And then how do you combine that short-term and long-term investment plan?
Well, really, the long-term plan is just a series of short-term investments. Some investors take the approach where you buy and you never sell. You get some good growth in the short term, you leverage from that equity and buy another property and repeat the process. Other property investors may buy and sell, they may trade property. You're not going to become financially independent in just a handful of years, in like 3 or 4 years. You do need to invest over a significant period of time. If you are going to buy and hold over the long term, it doesn't really matter so much what sort of short-term equity you get. It's just that it allows you to leverage from that equity sooner and get into the property market with your second and third if you can afford to service those loans.
This concludes part 2 of our 3-part series with Jeremy. Be sure to hit that subscribe button down below so you can keep up to date with when the next video comes out.